Introducing Ausbiz Capital GrowWise, a new fund which combines institutional insight and experience with a target return of 15% per annum.
Our fund mirrors SciTech GrowWise, backed by an 18-year track record with historical 21% average annual net return. With more than $1.45 billion under management, the SciTech GrowWise Fund is led by award-winning global portfolio manager Ivan Sherman. The same strategy is now available to Australian investors from as little as $5,000. Discover Ausbiz Capital GrowWise, investing informed by experience.
This program is brought to you by LGT Crestone, local private wealth expertise backed by the stability of a global presence.
Hello, welcome to Global View on this Wednesday. I'm Andrew Gagan. Good to have you with us again here at Ausbiz as we get across what has transpired on global markets overnight. Let's begin then with European stocks. They were mostly higher on Wall Street. US stocks did close lower. The S&P 500 and Nasdaq retreating from their recent record highs after some disappointing corporate earnings results, while investors awaited the Federal Reserve policy statement and news on trade talks between the United States and China. Stocks specifically, health insurer United Health was the biggest drag on the Dow after a disappointing profit forecast. And Boeing fell despite reporting a smaller second quarter loss. United Parcel Service shares plunged as the package delivery company posted earnings while declining to issue annual revenue and margin forecasts as tariff uncertainty weighs on the company. Whirlpool also tumbled with the home appliance maker slashing its annual earnings forecast and dividend, citing pressure from a pull forward in imports by rivals ahead of tariffs. Procter & Gamble forecast annual results below estimates and said it would raise prices on some products to offset the tariff impact. The shares in drug maker Merck finished lower as it said it was extending its pause on shipments of its vaccine Gardasil to China until at least the end of the year due to persistent weakness in demand. After the bell, Visa beat estimates for third quarter profit and revenue. However, the global payments processing company kept its full year forecast for net revenue growth unchanged, sending its shares 3% lower. Spotify shares dropped more than 11% after the music streaming service fell short of Wall Street expectations and posted weak guidance for the current quarter. And in Europe, shares of Novo Nordisk plunging as much as 30% after slashing its financial forecast after slumping weight loss drug sales led to a profit warning that wiped $143 billion off its market value. Now, also in news just to hand, the federal government has added Alphabet-owned YouTube in its world-first ban on social media for teenagers. It reverses an earlier decision to exempt the video sharing platform from the ban, which includes Meta's Facebook and Instagram, along with Snapchat and TikTok. Prime Minister Anthony Albanese saying in a statement, social media has a social responsibility, and there is no doubt that Australian kids are being negatively impacted by online platforms. So I'm calling it time on it. Social media is doing social harm to our children, and I want Australian parents to know that we have their backs. Social media firms will be fined up to $49.5 million from December if they break the law, which has passed through Parliament. And a YouTube spokesman said the company would consider next steps and will continue to engage with the federal government. Well, US and Chinese officials have agreed to seek an extension of their 90-day tariff truce following 2 days of talks in Stockholm, aimed at diffusing a trade war between the world's two largest economies. Meanwhile, in the latest US data, the country's trade deficit in goods narrowed to the lowest level in nearly 2 years in June as imports fell sharply in the face of higher tariffs. Consumer confidence improved less than expected in July, and household perceptions of current job availability were the weakest in nearly 4.5 years, while one-year inflation expectations slipped to 4.7%. And there was a decrease in job openings and hiring in June, with openings dropping more than 250,000 to 7.43 million. The US two-year Treasury yield fell to 3.87%, the 10-year down to 4.32%, and despite the fall, the 7-year bond auction was very strong, resulting in record high participation by non-primary dealers. And the market has priced in no chance that the Fed funds rate will be cut by 25 basis points when Fed officials reveal their policy tonight. And the US dollar index up marginally while the euro has fallen to a 1-month low and the Aussie trading at 65.1 US cents. Bitcoin at over 117,000 US dollars. Oil prices, they've surged as President Trump increased pressure on Russia to end the war with Ukraine and on optimism that a trade war between the US and its major trading partners is abating. Brent crude futures up 3.5% at $72 a barrel. Copper's up marginally, iron ore rising 2% to $101 US dollars a tonne, and gold edging higher ahead of the Fed policy meeting. Well, for more on what is driving US markets, given those recent record highs, I caught up with Sam Stovall, Chief Strategist from CFRA Research.
First off, July typically is a pretty good month for the year. It's actually the fourth best of all 12 months. And I think what was encouraging is that we continue to hear positive news regarding trade relations. So with every day we seem to have another country that has come to terms. I can't help but think about the Queen song, "Another One Bites the Dust." So that ends up being good. Also, the bar was set very low for second quarter earnings, but now we've actually at a pace doubling what the expectations were as of the end of June. So earnings are coming in better than anticipated. And our belief also is that the Fed probably will end up cutting rates when they meet in September, maybe give us a little bit of a dovish hint at tomorrow's meeting. But in general, things are looking pretty solid.
Can I just pick you up first on the trade deals? Do you feel as though perhaps these have been stacked in Donald Trump's favour, the terms of these deals?
Yes, I would tend to say that is the case. I mean, prior to these deals, the average tariff from our trading partners was about 2.5%. And here we are looking at a baseline of 10, 15, 20%. So that's something that the president and the administration has been pushing forward. And obviously our trading partners want to continue to trade. And so as a result, they've ended up going along with those demands.
So, Sam, you take a look at the equity markets. Perhaps as you look at those record after record, as I mentioned there, investors tend to worry or fret, don't they, that perhaps the markets have gone too far. Have they? What are you seeing in terms of those valuations?
Well, first off, the market is up about 30% since the April 8th low. Yes, we've had, 15 or 16 new highs for the S&P 500 so far this year, but we're only up about 3.5% since we recovered all that we lost in the February through April decline. And usually we end up with anywhere from a 7 to 10% gain in the post-correction period. So history would imply we still have a ways to go. In terms of valuations, yes, the market does look expensive. The S&P 500 is trading more than 2 standard deviations above its 20-year average, or in a sense, a 40% premium to what it has normally traded. Well, you could say that either that is a gigantic bubble or prices lead fundamentals, and earnings were essentially cut in half from the beginning of 2025 through the end of June, and now are just beginning to turn around and, in a sense, reflect the optimism that investors currently have.
Sam, we are in the midst of earnings season. Some big results, 4 of the Mag 7 reporting this week. Thus far, what are your observations about what you've seen?
Thus far, actually, has been pretty good. I think that the market would penalize companies if they missed either on revenues or did not offer the kind of guidance that investors were hoping for. We did see some companies do that today, in particular Spotify, UPS. Even P&G, Procter & Gamble, posted good results, but investors felt that maybe they weren't good enough. But when it comes to where most of the market cap is, that being in communication services and technology, we're actually seeing very strong numbers. Expectations are for a 14% rise in second quarter earnings for communication services and a 17% gain for technology. And those numbers look even better when you make comparisons for all of 2025 and 2026 compared with the market as a whole.
And when you look to earnings ahead, Sam, what effect is the big beautiful bill likely to have, I guess, on the broader economy and how that's likely to feed into earnings?
Well, I think just as the final result of tariffs has yet to be felt in the inflation numbers as well as in GDP growth, et cetera, I think the same could be said for the big beautiful bill. Certainly, it is a tax cut that will benefit those on the upper income scale more than the lower income scale. And what we're also seeing is that it could end up being stimulative to the overall economy because it's going to be adding about $4 trillion to our debt. So I think a concern would be that this could be stimulative at a time in which the president would like the Fed to start cutting interest rates. And maybe the Fed won't do so if we feel that the economy continues to plow along quite nicely. And also if we end up with inflation numbers that remain fairly sticky, as we anticipate with the upcoming personal consumption expenditure report, the Fed is going to be in a quandary.
We've also seen some lighter regulations in regards to the banks. How constructive are you on that sector?
Very constructive on banks in particular, but financials in general. We have an overweight recommendation on the financials group. We very much favor a lot of the major market center banks as well as some of the super regionals. And the financials have actually seen an improvement in their earnings expectations. As of June 30th, it was believed that the group would lose about 1% year on year. Now the expectation is for about a 6% year on year increase versus the 4% anticipated for the market as a whole.
Sam, interested to get your view on the healthcare sector with Donald Trump warning perhaps he will put a 200% tariff on pharmaceuticals. That's clearly of concern to Australian pharmaceutical companies. What's your expectation?
Well, certainly that is a strain on many of the pharmaceutical firms around the globe. We have an underweight recommendation on healthcare as a sector. We feel that there will likely be some pressure put on the pharmaceuticals. Novo Nordisk today reported less than exciting returns, and so that stock was beaten up as a result. So our belief is that while the group itself is trading at a fairly substantial discount to its longer-term PE ratio, our belief is that there's likely to be more relative strength pressure in the period ahead.
And just to look at tech too, particularly mega cap, Sam, given AI remains the dominant thematic, what's your view?
Well, I think that AI, while some people say that it's in like a baseball game, it is in the early innings. Others would say it's not even out of batting practice yet. So I believe that companies will continue to indicate that they are increasing capital expenditures. We are likely to see comments from Microsoft to that effect tomorrow. Azure is likely to see about 30+% growth in the June quarter versus the 33% growth that was seen in the March quarter. And so AI, I still think, is very much a driving force. And because of that, whenever we do see sell-offs in the market, it initiates a buy the dip mentality from investors who have yet to be shown that that is the wrong thing to be doing.
That is Sam Stovall from CFRA Research. All right, let's turn our attention to the local market just ahead of the open there. We're expecting a modestly negative start, down some 7 points. Stay with us because we're going to get right across that in just a moment.
This program was brought to you by LGT Crestone, local private wealth expertise backed by the stability of a global presence.